Welcome back. Let's take note of the numbers coming in from the auto pack yesterday. Ashok Leyland reported a weak set for their third quarter earnings ending December. The revenues declined about 36%. But for more detail, we have Sonal filling in for Sonia. Sonal, what do you make of these numbers versus what the street was working with?
It is a weak set. In fact, it is a decline on all parameters. It is below the pole on all parameters. In fact, the margins are at a multi-month low. So let me run you through the numbers. Revenues have declined by 36%, coming in at 4,000 crores, which is lower than the pole of around 4,100 crores. EBITDA has declined 65% on a year-on-year basis. Margins, they have come in at 5.6%. And that is a decline on a year-on-year basis versus a poll also which was expecting a margin of around 5.8%. Net profit has declined to come in at 27 crores and the street was working with a net profit number of 66 crores. And if you go through the margin trend, it'll come up for you on the screen. We will see that the margins have continuously been declining. In Q3 of FY19, it was 10.3%. Last quarter, it was 5.8%, and now it has come down to 5.6%. So a big miss as far as the margins are concerned. Credit Suisse says that it is a weak number basis the margin number, and the staff costs have also declined substantially, but they do expect it to correct in substantial quarters. But on the whole, it's a weak set. Yesterday also the stock was down 2%. Expect some more pressure on the stock today. But let's also talk about some previews then. BPCL is expected to report its Q3 numbers today, and we are not on the reported basis, while we are expecting good numbers this time around. So let me run you through the fine print then. Revenues are expected to go up by 7% to come in at 68,700 crores. EBITDA is also expected to increase by 26%. Margins should see a number of 4.3% versus 3.7% on a quarter-on-quarter basis. But it is the net profit that is expected to decline because of some adjustments with respect to other income, that is the dividends coming in from their parent. But in terms of the core gross refining margins, there we are expecting some sort of weakness. It's expected to be poor at that around $1.4 per barrel level, which is a decline on a quarter-on-quarter basis. Inventory gains are expected to be at $0.7 per barrel. That is because, the crude prices, they had gone up, and that's why the inventory gains will spike up. Reported gross GRMs, that's why will look healthier this time around at $2.1 per barrel. However, refinery throughput this time around will look lower at 7.5 million metric tons because the company had undertaken some shutdowns, some maintenance shutdowns this time around, and that's why we are expecting a decline in the refinery throughput. And this shutdowns were in relation to the BS6 upgradation. Apart from that, in terms of marketing volumes, we are expecting a 2.3% growth in domestic sales volumes because the diesel demand also looked healthy in this quarter. But apart from that, the gross marketing margins are expected to be stable. So all in all, we are expecting good numbers. But do remember, the other OMCs, they have disappointed on good expectations. So it'll be interesting to see how BPCL really performs.
All right, so that's about BPCL. The stock ended at the low point of the day, but the stock that ended at the high point of the day yesterday was Nestle. Expected to report numbers. Remember, the stock has been a star in all of last 12 months, a little more than that as well, plus 50% gains coming in. Not particularly cheap. Started the year with almost around 60 times in 1 year forward earnings, and now that has turned to 66 times 2 year forward earnings. So that is something we will keep an eye out on. But rightly so, 11 quarters of double-digit growth is what the company has posted, and this time around as well, the 12th quarter, the street expect the company will go ahead and post 10.5% growth in their revenue. 3,200 odd is what the street is working with. However, remember, the company is relatively immune to the slowdown that we're seeing in the rural segment because that accounts for only 25% of its overall revenue. 19% growth in the EBITDA, 732 crore is what the street is working with. That would mean a net profit jump of a lot more, given the fact that there would that additional booster coming in from the lower tax expense as well. 40% jump in the net profit, just shy of that 500 crore mark is what the street is working with. Domestic business grows in double digit. The exports business, which is a small part of their business, sees a marginal growth. But more importantly, it'll be interesting to see what the gross margins of the company do, because over the last few quarters, we've seen the gross margins of Nestle decline because input prices have increased. And just as we saw, Lata speak about the CPI as well, that's telling you that input costs are inflating. But despite lower gross margins and higher costs of inputs, the company's EBITDA margins are likely to improve because lower other expenses. What had happened in the previous or comparable quarter was other expenses jumped by about 30%, and that would normalize and that would boost the EBITDA margins. Management commentary on demand resumption, on their increase in distribution and input costs would be key, along with the new launches that they've made.
Okay, Mangalam, thanks a lot for that. It's time for a break now.